Let's get on to the weekly macro outlook of currencies, starting with the Japanese yen. Firstly, this is the equally weighted index for all the major 8 currencies, being Japanese yen, euro, dollar, pound, Canadian dollar, Australian dollar, New Zealand dollar, and Swiss franc. So start looking here. This line is currently the start of the year of the 2026. If you look at here, the currency is trending downwards. It is continuing the trend of the previous year. It was already going down. Now the acceleration has stopped a little. The slope has widened. It's very wide right now. I think one of the major reasons being that it is already very low compared to the US dollar, and the Japanese authorities have said a couple of times that they might intervene in the markets if it goes above 160. So that is one of the major reasons why it is not falling at a strong pace like it was in 2025. Also, Japan increasing its rates has had not much of an effect on the currency itself. I was actually quite surprised when I saw that even with the war breaking out, it hasn't had a greatly positive effect on the JPY. So it's a safe haven currency, so it should have accelerated at least a little bit. I would expect it to go to these tops. I was thinking about that earlier too, but didn't really happen. If I look at it here from a technical perspective, I see this small wedge forming. Currently price is sweeping below the wedge, this area, and it's come back but has not cleared out the bull candle. If it does, I think there is still a strong possibility that it could accelerate to the top. Last year the inflation had become a major problem for the BOJ, and that was one of the major reasons why they were thinking about policy like rate hikes. But now inflation is coming down a little, so I don't think inflation is much of a problem for the BOJ. Only the currency depreciating a lot, and they've said a couple of times that the intervention is most likely. Interest rates have risen substantially. These we can see at the 2024 lows. That's when Japan told us the sudden spike that they would be increasing interest rates after, I think, 7 years or something like that. That was the main spike, but since then it has not been able to hold that place. Right now they're at 0.75% interest rate, which is higher considering what they have been for the last decade or so. If I look at it here from a weekly perspective, I think it still has a strong chance of moving upward. This more or like, instead of a trend, looks like a range to me. So I would expect that at some point it goes down here, goes up here, comes back, and then heads up. At least till these levels would be a most likely scenario for me. That's what I'm thinking right now of the JPY at least. Moving on to the next currency, we look at the New Zealand dollar. So if you look at it, it was performing like not so great in 2025. Strong bearish fall, and this was actually a little spike here. If you look at it, this was clearly a two-part rally, 1 2, and it very clearly came to the last demand zone of the last time, and that converted into a supply zone and then fell from here. This strong pullback, I don't think it is a true pullback. I still think it should lead to a fall near these lows. So this remains the most likely continuing target for NZD. Since conditions are still not that great on the risk sentiment, even though they looked on the Friday, they looked good on Friday, like the war would stop, but that's not likely happening right now. So I still think that it should continue. The interest rate is what is not leading it to a continuous downfall, because they're still at a stable interest rate. It's 3.1. So I think that is still affecting them, being buoyed a little. But in the longer run, I think they would need to decrease it, and a fall near here looks still very much likely. I think after that it couldn't continuously range. This year has obviously not been great for currencies, but again, it could still fall down first here and then go up. I see the ideal path as somewhere here, and then here. This is my likely target. Below this, like Here I think it should come. From that we can look to see like where it goes, but this looks the most ideal target for now in the short run. Moving on to the next one, we have the British pound. So now if you look at it here, unemployment actually remains quite high. Their interest rates have not fallen a lot, and if you look here from a broader perspective, you see that it's currently in a clear range. This is the range it has formed. It's not going up, not going down much. I think this is also one of the reasons because their interest rate remains really high compared to the state of the UK economy. That also means that they would limit any kind of major growth happening in the UK because of the interest rate. Business confidence is low and retail sales are low, so the consumer is suffering, which should essentially help BOE not raise interest rates by a lot. I think as soon as the war subsides, they are likely to decrease interest rates. At this point, can we continue to see it forming into a range? Most likely it should continue in that range, but at the end of the war, when conditions are right, I think it should continue to fall rather than increase. They've been on a great bull rally because of the higher interest rate compared to all the other economies, but now that is over, I think that they should continue falling because the economy itself is not that strong. So what I see further happening is likely going it to the top. It could be here, go here, come here, go there, but essentially after a couple swings here, I would expect it to come down probably till next quarter. I think it is a likely scenario, even though this week has been a little bit of it is bull flagging kind of right now, sorry, bear flagging kind of right now. It's like this again, not able to reach the highs is a good enough point that it could further come down here too. They don't have a lot of positives right now, but the inflation spiking would allow the BOE to keep rates higher for a little longer than usual. Now looking at the Australian dollar, I think Australia has been one of the most best performing currencies. Obviously you can give a major part of reason to the interest rates, which are like right now the most highest in the top 8 currencies. It's at 4.1, which has led to this long rally. 2025 was a great year for the Australian dollar, and now also the strong rally that happened. And if you look at it here, it's kind of this strong pullback was enough reason to see the rally might be stopping by now. This is the white channel forming right here, and it's right at the top of the white channel. And given the risk scenario right now, I didn't think that it would accelerate this much, but it still could be a blow off top kind of a thing. It is forming right now. It can't break out above this level, so ideally I would look it to come down, probably even lower, but interest rates higher are what makes me think that this could still be a range forming rather than a continuous downfall. I think they're already prepared for small inflation spikes because as you see that their interest rate is pretty high and makes for a good carry currency right now, given that Japan is continuously depreciating. I think the carry trade is not functioning greatly right now, mainly because of the fact that Japanese have said that the intervention is quite possible, and I think that is one of the reasons that is not allowing them to be a great carry currency, given that Australia is greatly dependent on world economics and exporting metals and everything. I think it doesn't make for a great carry trade right now, though I had a carry trade running in the last year, but this year I've had a little rally. I've caught a little rally here, but mainly with the New Zealand dollar than with the other carry currencies, I think. So again, think of a range from here. Even though the bullish rally is that strong, I think a range looks most likely, or it could just accelerate really slowly. That's the two possible scenarios we have for the Australian dollar. Moving ahead, we move to the euro dollar. Now euro, obviously it was performing really well with the announcement of the German the fiscal spending and the defense spending that they increased. But since then the risk scenario has shifted. Obviously, as you see that the rates are not that high right now, they're at the lower or neutral end, as they say. And I was watching it here and I saw the double top and I thought that it would come down to this level, and it did come down to this level. Now this Now the strong rally still suggests that possibly a likely range is possible. I think the major upside is still out of the question for euro right now. I don't think, oh sorry about that, I don't think a major upside is still possible in the euro, though it might range for a little. It has been performing a little well, but I don't think this is a great rally. For me, this is not a great rally. For me, this is likely a pullback of the bearish structure. Could likely fall further, come down here, because the economy in itself is not great, and I don't think they're looking to increase rates so soon, because inflation would probably be the worst for the euro area, given the backdrop of no Russian energy, and now the energy through the Darian ports is also getting blocked for the EU. So that's a problem. So their hopes of getting the economy working is right now not looking great. For this year, I think it should still continue to essentially range. I don't see the bullish potential for it right now. Again, two scenarios would be continues to fall from here, or just ranges right here. I don't think it will go back again to the right here, the tops. I think that is quite likely, most likely done for them. Consumer is definitely suffering in the EU, so I think they might even lower rates once they see that the energy is probably subsiding. Now we come to the US dollar. Now you see US dollar is also, like, this whole spike was again Trump came back, and now if you look at it, it has just been ranging continuously. Right now at the low end of the range. I think this makes for a great trade. I think it has strong potential for it moving up. One of the major reason being, firstly, that the economy is currently, like, it's doing good, at least on economic data side. I think they're doing good. Interest rates, they're staying close to neutral but still remains high, and with the current energy crisis going, I think surprise to the upside is the most likely for the US. Unemployment has not spiked yet, even though we see strong layoffs going on in the US, but due to that, I think even minor inflation spikes would lead the Fed to increase rates on a medium to low time frame, even though market was positioning for a rate cut. But I think that is mostly overdone and would lead to either the rates staying stable or even probably hiking a little. I think the risk scenario, the risk sentiment right now also supports the USD strongly. So that's what we could see. Inflation controlled, but spike in March, and I think that spikes should continue given the oil backdrop right now. Sorry. Now moving on to the Canadian dollar. You see right now it was already in a range. This range was right here. After that broke out, but couldn't really form new lower low or something like that. I think, it couldn't go past the last lows that were actually forming. This made them stay in a range, and I think that's the most likely assumption. Even I could expect like a small, upside potential for the Canadian dollar. The economy is doing a little well. Their inflation rates not that, it's not that high right now. It is high compared to other economies, but right now compared to Canada, it's a little lower. The interest rate is also in neutral territory. It is less affected by the oil spikes and everything. So I think that's a little upside potential for the Canadian dollar. Within this year, I could still see it moving here and then here over the upcoming months, upcoming quarter. But right now, that's the assessment for the Canadian dollar. Economy is doing better, and that should be supportive for the Canadian dollar. The Swiss franc. So one of the best performing currencies. I think I caught a couple of longs in the Swiss franc, and they were great because they accelerated so quickly, and it was a great thing for them. Now if you see right now, even with the current scenario, with the war going on and everything, it has not really accelerated that much, even though it's a core currency. So we see this ranging, and I think that is one of the reasons is because US offers much great interest rates right now, and it's not really depreciating, so that makes the Swiss franc less attractive. I still see it being in a range. I don't think unless there is some pure crisis happening in the US that Swiss franc would accelerate a lot. Obviously, the Japanese the Switzerland authorities would like the currency to be lower, but the main problem is the US have called them out on currency intervention before. That is one of the major reasons that they have not intervened even at these high levels. Small interventions are most likely, but they won't do anything to upset the US as of this time. So that makes it a good range currency for right now. You could see the range being this or this. That's the most likely scenario. It will continue on here. If you see, even after this strong rally, if they were not that strong, it would fall further, but it's not falling. That means people are still holding on to their longs. They're not really selling the currency. They're still buying at lows and getting profits out on the highs, but they're not really actively shorting the currency. That makes for a good carry. That makes for a good range trade in this currency. Now we move on to Nasdaq. So the rally has been great for Nasdaq this last couple of days that the rally has happened. I am not really sure of this rally. I think that the rally might be a little overdone at these levels. P ratios come into play, and that was already a thing that people were worried about. I think the last double top that formed right here could still be a good enough reason for markets to be testing and then going lower. Right now it looks great. This rally is very great, like 1 2 3 4 5 6 7 8 9, almost 11-12 days of bullish days. I don't think this rally has a lot of potential to continue upward, contrary to the market belief. I think inflation will become a major concern, and obviously AI is disrupting jobs left and right, and that should essentially not be great for consumers. That would lead to some pushback in the Nasdaq. Obviously right now you shouldn't bet against this, because if you look at it, this bullish rally, you shouldn't bet against it. But if it continues to fall below this level, near the 24,200 24,400 level, I think then it would be great to continue shorting it all the way to the lows, near these lows. Again, it is very much, even though it looks like a bullish structure, it is a range price action. Goes up, comes down, goes up, comes down, comes down, goes up, again forms a kind of range. So I think this area near the 22,900 level is still very much likely for the Nasdaq to approve. But if it continues expanding in this week, I don't think it should expand a lot, because all this rally was on the back of a ceasefire coming into play and Iran opening the Strait of Hormuz. But now that that's out of the question, again the ceasefire is ended and the world again looks like in escalation phase. So I think that should be bad for the Nasdaq in the coming week. Oil, one of the most great assets, performing great right now. Obviously 2026 has been the year of oil, but I don't see it accelerating a lot right now. Obviously if the conflict continues, we could still see it spiking above the 115 level, but even given the backdrop of the conflict, even only if there is serious escalation with ground troops getting there and not finishing the operation rather quickly, then I think the whole oil scenario above 120 comes into play. Otherwise I still think it should continue to range. Small spikes obviously should be possible, but it's a very erratic asset to trade right now. It's all very news dependent right now, so I don't have major biases for oil. I would still like to be in buy territory more than sell territory, but given the backdrop of Iran, that looks very likely that it would not fall off a lot, because they're willing to fight it out, which was not expected by the market. They thought the war would be over rather quickly. That has led to all this bullish rally. I still see likely a continuation happening right here, like a continuation in the form of a range, but not much upside. I don't see a lot of upside for the oil unless we see serious escalation in the war. That's when I would expect it to rise above 120. Gold. So one of the best assets performing over the last year has really changed its course in the current year. I the very surprising part for me is that we've seen this strong correlation between NQ and GC, like gold and Nasdaq, which actually shouldn't have been there, because actually gold is a safe haven asset and Nasdaq is not. But still we're seeing this correlation, and in this time of war we should ideally have seen gold expand even further, like really quickly, but we have not seen that. That makes me believe that people are not, I think some longs have gotten shifted towards oil. That is a greatly possible scenario. The debasement trade, unless that there are better trade options for people, but still they're not actively selling gold. Like they've not taken it to levels prior to 2026, or even came back to the 3900 level, which I thought was very likely. If this rally had failed, I was thinking it would come down to the 3900 level, but it actually didn't. So small rallies, small pullbacks. I think this should be a small grind right now, rather than a very quick upscale in the previous, and like happened in the previous scenario from September and everything. It should be a slow grind up. It could still range, but obviously the long term perspective remains bullish, but it is better if you likely look at it from a bullish perspective rather than a bearish perspective. So that's it for today, guys, and you can join our group. You can DM access for more detailed macro insights, looking at currencies, rates, and discussing all possible trade ideas with you guys. Thank you.